Hey, John, thanks so much for joining me on this call. We're looking forward to chatting with you about industrial real estate.
Thank you. Thanks for having me.
So you've been in the business for a while and started as a broker, transitioned into ownership, and now full-time into ownership. Starting right at the beginning, why did you get started in industrial? What was the appeal or the attraction there?
So I started at Knowlton Realty, and I was kind of given 3 months to make my mark. And I originally started. I looked at values and said, "Hey, well, retail is selling for $400 a foot. I want to get into retail." And so I spent 3 months pulling titles and researching and kind of doing all the things brokers do and making phone calls and trying to make my mark in retail. And then Gerald Knowlton, who's an old grandfather of the industry, walked in and looked at me for basically after 3 months, and I don't know how much company resources I'd spent on pulling titles and out countless hours, probably 100 hours a week in trying to make my mark in the industry. And he says, "No, John, you know what? I've looked at your profile, I've looked at you. You are now an industrial guy. You're going to lead our industrial team here." And of course, back then there was nobody. There was no industrial team. It was an industrial team of one. So and I'm going to hire another guy, and you guys are going to be our Knowlton industrial team for Edmonton, and you're to focus 100% of your time on industrial. I'm like, no, okay, well, I'll just take all these files and throw them in the garbage, and away I went. That's where I got my start in purely industrial. I was pretty much blinkered. Blinkered on industrial. They used to have that term. I don't know if it's a common term today, but basically that's all you did. You 100% industrial. I started handling all of the Investors Group buildings here, and then now Prudential's buildings, just all their leasing. So I started off as a leasing agent, and kind of grew my knowledge and portfolio knowledge and stuff right from the get-go, leasing industrial buildings, and mainly on the institutional side. So got to understand how they think, and back then with Knowlton, the philosophy is you were in Toronto at least once a month. So I was living off of $1,500 a month and, trying to make your way. But hey, I had to go to Toronto at least once a month. And so I'd go Monday morning, I would fly to Winnipeg and see Investors Group and Great West Life and, whoever else would see me. And then Monday night, I'd go to Toronto and spend Tuesday, Wednesday, Thursday seeing all the institutions. I'd take the train to Montreal on Friday and, see Standard there, see Case, see, a bunch of the institutions there. And Saturday I'd fly home to be with the family. And that was my life for many years, actually. So then I started doing pretty well at that and got headhunted over to Colliers and started at Colliers from 1991 to 1995. And then that's when Knowlton Realty got bought by Terode, and Dave Young and Dave Forbes from CBRE days said, "There's no way I'm going to work for John Terode. So you want to come and open up an Edmonton office for CB Commercial at the time, which then became CB Richard Ellis, which then became CBRE." So Dave Young and myself opened up the office of Edmonton for CBRE today, and two of us looking across the table from one another going, "I just came from a great career, a 5-year career at Colliers. What the hell am I doing?" But I've always been blinkered on industrial, and that's kind of where I cut my teeth from day one, basically leasing and selling industrial buildings right from the get-go. So,
when did you start investing? Was that when you went over to JJ Barnaky at the time?
No. So that's an interesting story. So I probably put 80-hour work weeks in my whole time I was at Colliers and started to make some really good money. I was rookie of the year at Knowlton, and then went on to Colliers and did pretty good there with a lot of the institutional clients that I pulled over. But so every paycheck I'd kind of take 25% and stick it in the market, and 25% and throw it against my mortgage, and then kind of live off of the other. So kind of save 50% and live on 50%, less taxes, of course. So we lived a pretty moderate lifestyle for many years. But so I finally kind of got out from under debt, under my school debt, university debt, and all that kind of stuff, and started putting money into the markets. And finally got married in 1993, and kind of got out from under that, and decided, hey, you know what? I finally put some money in the stock market, and I got my mortgage almost paid off, and life is pretty good. That was about 1994, 1995. And so I thought, I'm going to take the family for a nice holiday. We went to Hawaii for like 2.5 weeks. And I came home from that holiday in Hawaii, and pretty much about 50 to 60% of my stock portfolio got wiped right out.
Oh.
There was a company called the good old Letty's, 360 Networks. It went from whatever dollars a share to nothing. And another one called Phillips Services, where the president absconded with, I think it was $30 million in copper, and went off to somewhere, I think in Italy. And then another one called Loan Group, which is in the funeral home services. They got a class action lawsuit against them, or anti-combines lawsuit or something in the U.S. that they lost, and their stock went from $50 a share to almost nothing, right? So I was crying in my spilt milk, and it was my dad that turned around and said, well, are you any good at what you do? And I'm like, well, pretty good, I guess, you try to be humble. But he says, well, stop putting money in the stock market, invest in what you know. And so pretty simple advice, and kind of started to scratch my head. And so I kind of retreated to the basement, and I wrote out a business plan. I think right then and there. Back then, a big thing was mutual funds, mutual fund this, mutual fund that. And everything was all about mutual funds. And I'm like, you know what? I'm just going to start a mutual fund of buildings, and I want to buy one building a year. And my dream portfolio would be to own 10 single tenant buildings and create a mutual fund of buildings. And I'd rather own 10% of 10 buildings with a bunch of friends and family. And so that's what I set my path on. I bought my first building in 1995. And I had a goal of, rather than putting money in the stock market, I'd buy a building once a year, and just find a group of buddies and said, okay, I need to raise $1 million. Who wants in? And boom, 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 and basically just focused on what I knew, and stayed in my, kept in my lane, and stuck to my knitting, all these old sayings. But I just focused and just picked up a building a year. Every year, I just stayed very, very focused on industrial all the way through. And that's kind of where I got my start.
Where did you make the decision that you had a big enough of a portfolio and enough cash flow coming in that you could actually focus on that full time?
Ooh, that's a tough question. It's having critical mass, and for me that was about 1 million square feet. But at the same token, I was a pretty good broker, and business. I was in my 40s, and business was pretty easy for me to come by. I'd worked at the game for 10, 12, 15 years, and so I was doing very, very well as an industrial broker, and I was always kind of top 3 in our certainly in our office and in the city. So, when you're making really good money and you got a young family, and it's like, okay, I'm going to just quit all this, and I'm going to focus on buying my own buildings. And so it until I probably should have got out of brokerage probably 3 or 4 years earlier than I did, but I kind of stuck through it because making money at the time in brokerage was for me was pretty easy, I guess. Easy, it's hard to walk away from a sizable commissioned, base when you just it just flows pretty freely or pretty good when you're good at it, right? So you take many years to hone your skills, and then just to walk away from it was tough. But for me, that was probably a little over 1,000,000 square feet, and part of it was just a bit of an age thing. And brokerage is a young man's game. I didn't want to work 80-hour work weeks. I had a young family, and I got to a critical mass that was comfortable, and it was okay. Well, how do I really leapfrog this and get scale and grow it? And I really didn't get scale until I left brokerage behind and just said, okay, I'm done with that world, and here's my new day. And then I created Camrock basically in 2011 and raised a bunch of money and kind of went hard after that. And that's where I got real scale and scalability and size. So it was good, but 100%, or 99% focused on industrial products, in Western Canada. We went down to the States a little bit and did very well on a couple of projects, but stick to what you know and where you know it and what you know best. So I've always stayed close to my market.
I want to dig into how you look at properties specifically when something hits your desk, and how you either do just the back of the envelope math or dig into it deeper. But even before that, I want to get more of your thoughts on going through some of those tougher economic times. So the .com crisis, you bought your first property set in 95 or 96. So you would have kind of gone into that. Didn't have as big of a portfolio as you do now, but I'm sure there was still some pressure there. And then the Great Recession, 2008, 2009. How did those feel compared to what we're going through right now? Some people might say it's technically a recession. Some people might say it feels like a recession. Interest rates are certainly cause for concern for a lot of people and making it hard to get a deal to pencil. How does this, what we're in right now, compare to past recessions?
Well, you have about 15 questions you just rattled off at me there. So, yeah, I've certainly seen a few market cycles. This market cycle is I think unique to the other ones to some degree. And it's largely driven by federal policy that none of us really have any control out west here. So, as long as the feds continue to spend outlandishly, they got to control inflation by interest rates, and the related cap rates are going to follow. They have to. There's just no spreads today, so it's just brutal. So back that up. 95 was kind of the come out year for Alberta. They started spending $30 billion a year on oil sands. And so it's been just a complete, we had 20 years or better of solid growth in Alberta with the oil sands and different massive capital projects that were spending billions of dollars. So that just funneled into both Edmonton, Calgary, Lloyd, Fort McMurray, all the sub-markets very, very well. So it just feeds it across the board, right? So, we had very solid markets. There's a bit of a blip there, and I think 03, but not so much in Alberta. 07, when we had the what do they call it, the bond market, the
subprime mortgage or CMBS
subprime meltdown. I mean, that Alberta was still pretty strong through that. The trouble came on the back of that and the banks. So, to get any deals, we had a healthy market here, probably sub 4% vacancy rate overall. But to try to get a bank loan in 2008, 9, 10 was, I mean, you better have a huge balance sheet to work through that, and it was just very, very difficult. And I think we're there now on that, in that scenario. Banks all say, yeah, we're lending money, da da da, but try to get today, I don't know what you're seeing, but to try to get a term sheet that's an unconditional term sheet is one thing, but just to get a term sheet, before I used to be able to get them turned around in 48 hours for most of the institutions, and then all of a sudden it's now it's probably 30 days to get a term sheet, and then it's a conditional term sheet before you get a full commitment, and then you don't even know if you're gonna, you get a commitment letter, and then you go to fund it, and they change. It's like it could be the day of funding, and they're changing the terms and conditions of it. It's went to adjudication, and we can't lend you that, right? And it's just like, well, where this? I'm closing tomorrow. What the hell? So I mean, we haven't had that much of an issue with it. But I'm certainly I'm chasing a couple of properties right now, and a concern is just how to get it funded, because the banks, I think, have large loan loss provisions in their horizon, and they're not giving out the money real easy. So their spreads are higher, bond rates higher. We've had a recent decline in the bond rate here in the last week, but certainly a couple 3 weeks ago, bonds were 440, I think, 5-year bonds, and pricing typically for my product was 190 to 220 over, and today, some of the banks are quoting as high as 250, 260, 280 in one case. So that just tells me they're so concerned about their loan loss provisions that they're just not lending, or they're going to make it real expensive for you. So that's a problem. So that's kind of today's market. We're jumping all over the map here, but anyhow.
Yeah, and that was kind of my main question. If maybe I came at it from an approach of throwing a whole bunch at you at the same time and trying to get you to synthesize that into one answer, but that's where I was trying to get to, is what's the pulse on the market right now. And I would agree with you. It's really tough getting any investment deal to make sense. The sales that we're seeing right now, it's mostly owner user stuff, because the sellers don't want a fire sale right now into a market where cap rates might be up 100, 150 basis points from where they were 2 years ago. Are you a seller in this market, or you say you're chasing a few properties? How are you finding opportunities that make sense in this lending environment?
Well, I sold off a lot. Basically, I started about 18 months ago, and we got rid of about 1 million square feet, and which for us was a good bend. It was good timing. We were able to sell at sub 7 cap, 6.5%, 6% cap rates, which today I think would be a dream for a lot of vendors. But I just looked at it 2 years ago and go, like, our liberal government is crazy, and this is just going to end up with interest rates getting hiked. If you would ask me 2 years ago, are we going to get hit with 7 interest rate hikes over a 14-month period, I would say, oh, you're nuts. There's no way. But that's exactly what happened. And for real estate to work, you need a minimum of a 2-point spread. So with interest rates today in that 6% range, it doesn't make a lot of sense to buy anything under a 7.5, 8 cap, depending where you're at. I'm talking industrial. A lot of guys talk, everybody focuses on cap rates of multifamily and, and CMHC loan rates and stuff. And that's a different world. That's not the world I live in. And industrial is what it is. And I find it a very stable asset. Certainly for Edmonton, Calgary, and it's, it's a small market. I've stayed out of some of the small markets. I basically put in parameters if I can't get to it within an hour and a half or a couple of 3 hours or a day, I don't want to be there. So I stayed away out of Grand Prairie. I stayed out of Fort McMurray. It's just, if you've got a problem and you don't have critical mass in those markets, then you're wasting 2-3 days to deal with an issue. And I just didn't want to be beholden to that. So, Calgary's an easy because you're down there anyways. Have family down there, so it's an easy trip and it's easy to get to. But anyway, again, we're kind of fading off here.
So let's say an opportunity hits your desk. It's one of the properties that you're chasing, or someone just puts an opportunity in front of you. What's your process for perhaps just quick analysis of it, where it might be just a quick no, and then another two-part question, I guess. So there's a quick analysis on it, and then if it's of interest to you, what's your more detailed underwriting plan to determine if it's something you want to actually put an offer on?
My first look, and I kind of coined this a while back, is function first. So whether you got a good market or a bad market, if you don't have a functional property, in a bad market, you're the first to go vacant. You're the first to get shitty tenants, if I can say that. So I've pretty much always focused on function first is my mantra. And so that might be truck courts, that might be yard area, that might be, location, truck turning radiuses, access, what kind of property is it? Is it high bay distribution and a small bay distribution? Is it service industrial? A lot of people don't understand that the sub-markets in industrial are plentiful. There's, everybody groups it as commercial, which is brutal, but you call it industrial, but then within industrial there's another 4, 5, 6 subcategories to that. So my first thing is I totally look at what's the building look like, ceiling heights, function first of the whole thing. And if that doesn't, and that comes from 20 years of leasing buildings, right? Seeing what works, what doesn't work, walking through properties, and understanding, tenants' needs and requirements and how that might work for a multitude of tenants, or are you looking for a needle in the haystack? And so that, to me, that's the primary first asset. If you've got a building that's 70% site coverage ratio with no truck turning radius, no yard, no this, no that, no parking, low ceilings. It's just like, why go there? There's 2,700 buildings in this market. I'm only focused on a handful of them, and I don't need to own them all. So may as well own some good ones, right? The secondary one is I don't mind buying empty buildings. That's where the opportunity is in my mind. So, what is the opportunity? In some cases, it's fully tenanted, fully leased. Here it is. That's probably more for the institutional investors. There's an old saying: institutions are there to place money, and investors are there to make money. So buying a vacant building, fixing it up, improving it, doing, I call it the Rubik's Cube. You get in there and you Rubik's Cube it, and lipstick and rouge. There's a million terms for that, but fix it up, clean it up, lease it up, and then hold it is and your term of hold can be various depending on the product, but. That's kind of my second look, and then my third look is it just pure price point. Some people look at cap rates. Cap rates to me is it's maybe a very quick acid test, but it's certainly not the be all end all. It's probably I more look at what is the lease rate? Is it reasonable to market, and what's my reversion risk? So I could look at an industrial building that's got a $10 lease rate, an $8 lease rate, or a $20 lease rate. Um, you know, is the $20 one way above market and my reversion risk? So I'm going to own that building for 15 years just to get hit with a $5 or $8 reversion on vacancy or release. So reversion risk is huge in my mind. I just don't go down that path, and because you can wipe out a huge amount of equity in a very quick stroke of a pen. Sorry. So that's probably it in a nutshell, right? What can I do with it, and how leasable is it? How functional is it? And tenant retention. How sticky is a tenant? Is this tenant there for? I've got some great tenants that have spent millions of dollars to be in their location. Well, they're pretty sticky. They're not going anywhere. As long as you're reasonable and you treat your tenants well, then they're going to be okay paying your rent. And it's when you start trying to gouge tenants, they move for not unlike employees. Most employees won't move for money, but they'll move because they can't stand you, right? So tenants are the same. If you treat them well, then then they'll treat you well, hopefully. It doesn't always happen that way, but that's kind of the words to live by, I guess. Just treat people properly and your tenants well, and it all comes to fruition. So
absolutely. Do you have, going to the subcategories of industrial, do you have a favorite type or one that you gravitate towards more than the others?
I'm a crosshatch of a bunch of different ones. So I kind of look at the subcategories as a diversification of my portfolio. So, say I have a wire company. Well, am I invested, in that building, in that building, or am I invested in that tenant? And I look at it and say, okay, well, I can sleep, or I can be traveling, or I can be anywhere in the world, and that wire company is paying my rent, and hence each one of those employees are paying me 5 cents an hour, or whatever it works out to, right? So it's an interesting way to look at it, but I kind of sometimes look at each one of those employees for that tenant as in a way working for me. It sounds a little bit weird, but then you treat them that way, and you treat them well, and then they hopefully stick around. But the subcategories, high bay, low bay, service, is it warehousing? I probably have about a 50-50 cross hatch between all the different asset classes, but and that gives me a portfolio diversification within industrial. So that makes sense. So some of my businesses are electrical distribution, some of them are drugs, some of them are third-party logistics, some of them are service, oil field service, steel service. I don't have a lot of oil service. I actually got out of some of that, but it's a good cross mix of different tenants, and that way it's kind of like having portfolio diversification as you would in, say, a stock market portfolio. Would you put everything into bank stocks? Well, no. So you diversify amongst everything. So I look at my individual warehouse portfolio as a little bit of a stock diversification of portfolio, just by
going back to that mutual fund idea from when you wrote your business plan.
Yeah, tenant mix, tenant mix and a mutual fund of tenants, or a diversification of tenant mix. So you're not all exposed to 100% third-party logistics, for example, or IT, or oil patch, or whatever, right? That you take a look at it and you say, okay, I got 20% of my portfolio in oil patch and service industrial. I got 20% in, in third-party logistics, and so you can work through your portfolio and have a portfolio diversification through tenant mix. So that's it.
Have you done much in the development space, or have you focused more on existing product when you're buying?
I've done a little bit of it. I built some buildings, but I'm not staffed up. I run lean and mean. I just decided long ago that I'd rather third party a lot of that, and quite frankly, my expertise is more on buying a building and taking it, cleaning it up, and turning it. To take a greenfield or brownfield site and build from scratch today, you're 2 years of risk. I can buy an existing building. I can maybe turn it around in 30 to 120 days, or depending on what you need to do. And it's kind of like the whiskey business or the distillery business. Vodka, gin, is 30 days to cash flow. So if you take a look at warehouses, your cash flow on turnarounds is a lot quicker than developing a greenfield site with all the city stuff you got to deal with. Just all the development risk, right? You can go through a couple market turns by the time you get a building developed. And certainly we've seen so much volatility in steel and labor and drywall and all the commodity pricing across the board in the last 3 years. It doesn't make any sense to build a building today. It's hard. Certainly hard to make the numbers work. You have to have a very driven tenant to build a brand new building and accept the correlating lease rates to a new construction today. Some guys are able to do it, but they have to do it by scale. You got Panattoni building massive boxes of 200,000, 300,000, 400,000 square feet and leasing at single digit rental rates. You can't do that on a smaller scale. So it just doesn't work.
So you've sold off about 1 million square feet in the last year. Are you still in growth mode, or are you more in a wait and see what's happening mode until we have some more certainty on interest rates?
A little of both, actually. So I call it more of a retrench mode. So we had a 2012, 2013, 14, we launched a bunch of funds, raised a large amount of capital, and then went out and bought, a whole whack of buildings. And I put 10-year sunset dates on that. So that was part of the investment strategy right from the get-go was 10-year horizons. So we very much stuck to our goals and game plans. So starting in 2022, we started to liquidate all of those initial funds, and then 2023, we got rid of kind of the balance of them, and today we're down to just a couple of the general partner limited partnership deals, and then on those backs of those sales, I've taken those and redeployed those on a personal level. So started increasing my personal portfolio as opposed to my fund portfolio. That's just, I'm getting old, man. I can't do this forever. So, so I started diversifying with different other guys, guys that I know in the industry, and give them a little bit of money here and there and help them out and mentor a couple of different funds, both in Calgary and Edmonton here, and kind of younger guys that want to do some similar stuff that what I did. And I guess part and parcel, I've gotten spoiled a little bit, and my hunger isn't as hefty as it was, say, 20 years ago. So I'm not into working 80-hour work weeks anymore. I'm more into holidaying for 80 hours a work week, and maybe working 5 to 10 hours a work week. So.
Well, you've definitely earned it. Yeah. What's your general message right now then to guys that you're mentoring? Do you have like a something that you're saying consistently to them, or is it case by case basis, opportunity by opportunity?
You know what, it's more case by case. I'm going to say, I love helping guys out that say, hey, I got a property. What do I do with it? And you kind of look at it, and so many guys get dreamy eyed and they just want to, and it just, and you kind of look at it and go, "Well, okay, really, but that doesn't work. And maybe it's age, maybe it's experience, but you kind of look at too much of the negative, and then you got guys that just want to go and they want to buy stuff like, and you kind of look at it and go, well, you're going to get hurt on that one, right? And sure enough, it's happened in a couple of situations here, and but sometimes high water floats all boats, as they say, but I think with interest rates, that's going to change the market drastically. So guys that bought 2-3 years ago, and they didn't care so much about function or ceiling heights or this or that. They're able to put a little bit of paint on it and clean it up and maybe sell it for a profit. And I think that ship has sailed today with interest rates and the difficulty for financing, getting capital. Loan to values, the banks are underwriting at safe rates that are way higher than even current interest rates. So, you better have your low loan to value, probably 50%, maybe on a good day, 60% loan to value on some stuff. And that's, I think, why multifamily is still so popular, is because the government is helping to support that, right? And basically falsify that economy because of the housing shortage. Sorry, I just got my teeth done, so a little bit whatever. It hurts. Anybody who's had braces before, it hurts. So
you got them tightened?
I got them all clamped down this morning. So
So are you still bullish on industrial? If you could go back 10 years, 10 years when you did that big raise last, and you could put yourself today, still as bullish on what the next 10 years looks like in industrial, or is there more headwinds?
Well, there's so much going on in the world right now. Bond markets, are we heading to a world war? Oil shortage, is China going to short their bond market with the U.S.? China's been buying billions and billions of dollars in bonds in the last, and if they go to war over Taiwan, well, is China going to continue to buy those bonds? Or are they going to dump them? And last I heard is they're starting to dump. So that's going to change the bond market drastically for the U.S. and maybe for Canada. So if China pulls all their capital out of the bond markets and redeploys it in other countries, what's that going to look like? And the oil situation. We got one of the world's best oil supplies and friendly supplies, and yet we have a federal government that just wants to absolutely crucify us. So I think Alberta's an awesome place to be. I think I'm still very bullish on industrial as a whole. But saying that, you need that portfolio diversification on different product classes. And you see that in Calgary a lot with a lot of high bay distribution stuff. So you just have to be careful on what your asset mix looks like, and who your exposure is to. So as a whole, I'm still very, very bullish. We still have vacancy rates of what are we, sub 4% across the board today. In most markets, sub 7 is, a healthy market, and we've been sub 5s. We had a small blip there during COVID. I think we were into double digits, but that was for a very short period of time. And I came on the backs of 2018, 2019, when the Feds started their attack on oil. I think it's poor judgment by a lot of the institutions that are racing for the hills and dumping all their product right now. I mean, there's so much product hitting the market right now. I'm not going to sell my, I'm in a good place, and I'm not going to fire sell my product into the markets today just because the institutions think it's a good time to get out because they're off balance on their balance sheets, or they're outweighted on their bond market, or this or that. So what do? Well, let's get the hell out of Alberta, or let's get the hell out of real estate. So they dump everything. And that's what we're seeing right now. We're seeing a mass exodus on multiple levels. And to me, it's the wrong time to sell. It's a great time to be a buyer if you're capital rich, but there's only so much capital to go around. There's only so much to do. And I've been contemplating another large capital raise, but at the same token, I need a young buck to run it because I don't want to do it anymore. So there you can take it over. So
well, we'll talk when you're back from Mexico. What is your future or crystal ball look like, I guess, for when we see a return to normal? And there's so much, like you said, there's so many things out there that's virtually impossible to predict. But do you see this being a high interest rate environment for a while, or is at some point do you see retraction?
I think we're going to hold firm for a bit, but I think we're going to see higher interest rates in the medium term, and then return to normal. Well, what's normal? We've lived in a very low interest. Had the benefit of a very low interest rate economy here for 20 years now. I'm not sure what the exact number is, but it's been many years. And I'm coming off mortgages that are 2%, and they're being renewed at 6%. And fortunately, I'm in a good position on those, so it doesn't hurt me, but it's going to hurt a lot of people. If you've got 2.7, 2.8, 3, I got one mortgage that's 3.17, and the banks came back at 6.7 on it. Kind of like, are you kidding me, right? More than a double. That particular asset, we're less than 30% loan to value. So it's like, okay, well, that's just gonna, do I extend the term or whatever? But long term, I'm hoping that the Fed's smarten up. Maybe we get a new government. Obviously not a liberal, so hopefully the Conservatives get in and change some policy around Alberta, around oil, around interest rates, around spending and inflation. Is the U.S. going to get their inflation under control? The debt ceilings are getting hit all the time. They create wars to create balance of power and balance of trade and monetary policy, and it's a lot of funded by war. So every time a bomb goes off, well, that's only $10 million for a small one, right? So look at the Gaza Strip in Israel right now. That somebody's funding all that. So that's just the world churn of money across the board. And the more money gets spent, it just drives monetary policy across the whole world. So it's funny how we have heard almost nothing about Ukraine ever since the Gaza conflict has started, which is sad. It seems like that's taking their eye off the ball there in Russia and Ukraine and all that kind of stuff. But anyway, that's a whole other topic. Again, just back to interest rates. I think I'm thinking they're gonna come down a little bit in the next 3 months, and that's going to be largely driven by the bond market. So it's going to be, depends on what happens with the bond market in the next 3 months. But I think with the sell-off of bonds, there's going to be downward pressure on pricing, and so you're going to see that reflected in overall mortgage rates. Now, are you locking in for 5 years? You're locking in for 2 years, or are you floating? The float rates right now are huge. They're very high. So you're probably not going to do that. So you got to, you're going to bet on 2 years, you're going to bet on 5 years, and I think in 3 years we could have higher interest rates today than today. But that's a total dart in the throwing a dart in the dark. It's trying to crystal ball today is very difficult. There's just so many adverse things going on worldwide, and crazy monetary policy by all levels of government. Until we can get our spending under control, then I don't think our interest rates will be under control. So.
And I don't think we'll accomplish that with the current government. They're spend happy and there's no accountability. It's difficult to see a future where with them in power where we'll have any normalcy to even think of.
Yeah, it's hard. 10 years ago, you might see the billion word, now and again. And today there's no rhyme or reason to $1 billion. It's that's 1,000 million. I'm sure it's still not worth 1,000 million, but when you see government funding, we just spent $40 billion, and it's like nothing. It's just like, well, someone's paying for that, and we don't have a huge population. We don't have 400 million people. We have 40 million on a good day, and probably half of those are paying taxes. So if that. So it's tough to put a finger on it for sure. I think short term we're going to be steady. Midterm we're going to be higher. Long term it's a crapshoot. But I'm going to say we're probably 100 bips lower than we are today long term. But that's not much reprieve if you're coming from off a 3% mortgage to a 6% mortgage. So maybe we stabilize at 5. I don't know. But that's kind of my read on things. Be flat, it's going to go up, and then it's going to come back down.
So with all the uncertainty and global turmoil, what's your base case right now for investing in industrial?
Base case? It's just got to work. It's got to work financially. It's got to work functionally. So, I've got an asset on the south side we've owned for 21 years, and I was just talking to an individual, and in 21 years, we've lost 1 month of rent.
Wow.
Because the building has good function, good location, good this, good that, and so if you stick to, if you stay focused on what works, I think you'll do well. And today, if you've got dry powder and you can buy, stressed asset for whatever reason why it's stressed, maybe it's flight to quality, maybe it's just flight to volume, or whatever. I think there's a great case to be made where, say you raise $200 million and buy, $500 million in buildings, but you probably want to do that across the country, and I certainly want to. When we launched our funds, I was buying 1 to 2 buildings every month for 3 years. So 40 buildings later, you're wore out. It's a lot to buy a building a month is a lot of work, and people don't understand how much work it is to buy and to sell buildings today. Actually, you almost need to handhold the buyer when you're selling a building more so than when you're buying it yourself. So. We all make mistakes along the way, and hopefully you can limit them. But on a go-forward basis, I go back to my original comment on function first, and the asset itself has to work. And if you're buying it vacant, then what's your risk tolerance, and then if you're buying it full, what's your downside risk and reversion risk, and does it work today? So That's kind of it in a nutshell. And there'll never be an end to buildings, but there'll always be an end to money. So place your money carefully. You know, it's kind of it. I'll run out of money before I run out of deals.
Yeah, isn't that the truth? Well, I still had more things I wanted to ask you, but I don't want to go into too many different directions. So if you're up for it, maybe sometime next year we could pick it back up, because I want to do a deeper dive into that function first, and really just explore ceiling heights. What does ceiling heights need to be? What about power? All these companies seem to have more power requirements going forward. A lot of that old infrastructure doesn't have adequate power. So if you're up for it, maybe we could do a deeper dive into this sometime next year too.
Yeah, whatever works for you. I'm pretty flexible. So,
Cool. Well, I know you're heading out of town, and you're gonna have lunch with your kids before you go, and then you're out for a few weeks.
yeah, for sure. Well, travel lots. You can only do it for a while. So anyhow, one thing COVID's brought to us is mobility of work. So that's pretty awesome.
Yeah.
So
You can do a lot
these
from
little things are
yeah.
a crazy ass necessity when you travel lots, but they can manage to do a lot and accomplish a lot, and you don't have to be sitting behind a desk doing it. So,
Yep, that is one of the features.
Well,
So I won't keep you any longer, John. I really do appreciate your time. It's I really enjoy getting to just bend your ear and hear your wisdom over 30 some years in the business. So I really do appreciate your time.
yeah, no, thank you. I love your podcasts and your show. I watched a few of them here and there, and I pick them up, and I get a chuckle out of them. You have a good array of topics, and really enjoy it. So hopefully your editors don't edit this down to 3 minutes and add a cartoon at the end of it. So anyway, enjoy your show. Keep up the great work. You're doing an awesome job.
Thanks, John. Much appreciated.